Peter, welcome.
Thanks, Rob. It's good to be back.
Well, it hasn't been that long either. I think it was just last month you were on, and the markets continue to throw up some surprises for us, which, of course, I'm looking forward to asking you about a little bit later. But where I wanted to start today was a bit more back to basics, looking at things through the lens of philosophy and process. When I speak with clients or consultants, often a question I hear about emerging markets is, well, gosh, are there things that we have to do differently or way differently when looking at emerging markets companies or an emerging markets portfolio that you just don't have to do in the developed markets world? And so can we start there?
Yeah, we get that question all the time. And really, 90% of what we do is the same across Mawer's equity strategies. So following the same philosophy, the same process, and no different in emerging markets. There's always maybe some subtle tweaks, particularly around macro, a little bit more macro awareness with emerging markets. But really, like I said, 90% of what we do is just following the philosophy, following the process, and that's no different in emerging markets. One thing that's exciting about the universe is that it is a less efficient universe. So in our philosophy, we look for wealth creating companies with excellent management teams at discounts to their intrinsic value. And we're always making some trade-offs between those. There's no perfect investment. But what we find in emerging markets is we can more frequently find those great companies with great long-term growth outlooks at very attractive valuations because there's more pockets of inefficiency. And if you're willing to roll up your sleeve and turn over more stones, we can surface those. So, and it even happens amongst the most well-known company, the largest company in emerging markets is TSMC right now. It's growing 20% a year and it's 16 times earnings. So you don't see that in developed markets. That kind of fantastic, one of the world's best businesses, best management teams, fantastic quality, great growth outlook at an extremely attractive valuation. But that's just one example. And if we go through the portfolio, go down the list, there are many examples like that. So it's really just the same bottom up, less, but I find we don't have to make the trade-offs as much. And then there is more macro awareness where that comes in. We have to pay a lot of attention. There are big macro swings in emerging markets, macro and geopolitical, I would put in that same bucket. And we have to manage the risk. We're not looking to make big calls or big bets on countries, but we think about what is the appropriate discount rate for a specific stock in a specific country? Is the risk reward worth it? And really spending time thinking about the discount rate as much as the cash flow forecast in our discounted cash flow estimates and fair value estimates. And then managing those overall exposures at the country levels. If we find a lot of attractive companies in one country, we still need to manage the weight and manage that risk. So we do think about that a lot, and it is part of the process. It just gets maybe more emphasis in this strategy than it would in some other strategies.
Okay. Peter, I've heard clients express, and by the way, this wouldn't just be this year, this would be probably a couple of years in a row now, that they feel like we're in a very macro-dominated market today and again for a couple of years. I'm curious whether you accept that premise as a bottom-up manager. And like we all saw the poster board on Liberation Day, but I'm just curious, regardless of whether you accept the premise or not, are those impacts of these macro events or implications, are they being felt evenly across the emerging markets landscape?
Yeah, I do think that's a fair assessment. There is more macro drivers impacting stocks, more geopolitical uncertainty in the world. And say over the last 5 years or so, this has been the trend, and it's something that even bottom-up investors need to consider and to contend with. It impacts everyone, but not necessarily evenly. We saw on Liberation Day when Trump announced tariffs around the world, China got hit with the highest tariffs. Apparently, there was an immediate impact. Lots of factory orders immediately stopped. Now the tariffs are temporarily lowered, and there's a rush of orders to get in during this lower tariff period. And so it is impacting real businesses on the ground. And we have to try to look through that, for the long term, what are the businesses, the companies, the management teams that can not only survive, but thrive in a more uncertain world.
China is obviously a pretty important part of the emerging markets universe. We've got a pretty healthy allocation to Chinese businesses in the portfolio. Can you talk a bit more about the character of those companies that we own and just some of the work that you've done on them in the last little while?
Yeah, there's lots of great companies in China. There's lots of not so great companies too, but that's the beauty of having a large universe. We can be very selective and focus on those really high quality companies that meet our criteria. And we've found a number, and we've really emphasized the ones that are exposed to the domestic economy, not reliant on that manufacturing export economy that has been the main driver of China's growth, but is reaching its limits and being tested in the current trade war. So companies like Tencent, the social media leader, Tencent Music, which is a listed subsidiary that does music streaming, NetEase, a gaming company. These companies have all done very well recently, despite the difficult macro backdrop in China. And the common theme is that they're not reliant on exports or manufacturing. They are reliant on consumer spending and low dollar amounts, gaming, online streaming, so less likely to be cut even in a weaker economic environment. But that said, we are seeing signs that the Chinese government actually is probably doing some stimulus. They're not doing big splashy headlines, but there are signs that they are supporting consumers, supporting the economy more, and that's also providing a more favorable backdrop in what otherwise could be what otherwise is a challenging environment in China.
We've also seen at the same time, and maybe this goes beyond China, but you mentioned earlier thinking a lot about discount rates. We've seen some pretty big moves at the long end of several rather important government yield curves around the world. We've seen some big currency moves too. I'm thinking most notably of the U.S. dollar, but also the Taiwan dollar more recently. How have you thought about that in the current environment? Just going back to your comments around discount rates.
We think about currencies and having a well diversified, resilient portfolio that can do well in a range of different outcomes. And currencies are inherently very difficult or impossible to predict. And so our approach is to be diversified, have exposure to a range of currencies, but avoid overexposure to any one currency. You mentioned the US dollar being weakening recently. Historically, the US dollar has been a safe haven in times of volatility. Investors hide out in US dollars. And that's attractive in an emerging markets strategy, which typically is a more volatile asset class, and having some US dollar exposure can buffer that. We have that, especially through our Middle East investments, companies in UAE and Saudi. We have some great businesses there, and they happen to operate in local currencies which are pegged to the US dollar. So that's some kind of indirect exposure to the US dollar, which again has historically benefited the portfolio in times of stress and that USD strengthening. Right now, we're seeing the opposite. Decreasing confidence in US dollar associated also with the rising bond yields you mentioned, and we're seeing USD weakening and other currencies strengthening. So there's a lot of volatility. We're not making any shifts on this. We think the portfolio is already well positioned and diversified, but it's something we have to pay attention to as well and make sure we don't have any overexposures to a single currency.
You mentioned the Middle East. When I look at the portfolio, one of the regions that stands out as having a generous allocation in terms of where we're finding businesses is EMEA, which, I mean, maybe you think it's a ridiculous bucket. Europe, the Middle East, and Africa. I mean, a pretty wide selection of potential countries in which these companies operate. But, regardless of the bucket and how it's defined, what is it about that region? And maybe we can start with Europe. What is it about Eastern Europe that seems to be a pretty great font of ideas for us as a team?
Yeah, I think like you said, emerging markets as a whole, I mean, is a very heterogeneous universe, and a bucket like EMEA is again equally heterogeneous. But one of the common characteristics they have is more off the beaten, off the radar markets. So if you look at EMEA, I think it's roughly 10%, slightly higher of the benchmark, but about 27% in our portfolio. And that's driven by bottom up where we find opportunities. The largest country exposures within that would be Poland and the UAE. 9% and 7%, respectively. So again, we're not making really big bets on any single country, but in that bucket of EMEA, there are lots of off the radar, overlooked countries where liquidity is a little bit lower. A lot of the investors just aren't turning stones there. And that's our bread and butter, where we love to roll up our sleeves, turn over stones, and find great companies, great management teams building phenomenal businesses for the long term. So when my teammate and I were in Poland in December, we went there together. We rented a car, drove around the countryside, visiting small towns, stopping in at convenience stores, eating the hot dogs at the gas stations, visiting the grocery stores, shoe stores, all kinds of factory tours, as well as the typical management meetings, but really getting to know the entrepreneurs and the culture in the country. And there's a lot of great businesses there. And it's similar in the UAE, where there are a lot of great businesses and just unturned stones that are overlooked by many investors.
You mentioned meat counters. I know that's a particular investment we have in Poland, but one of the more notable additions to the portfolio so far this year, I think, in fact, the largest addition, is Asseco Poland.
Yeah, that was a newer addition to the portfolio since our trip last December. And it's a company that's been on our watch list for a number of years. It's an acquisition-led company of niche software businesses. Generally, they're buying very good businesses. We like that general strategy, but the prices they were paying and the returns they were getting weren't great. We thought there's room for improvement on the return on invested capital that they're earning. And for that reason, we were on the sidelines. That changed when Topicus came in as an investor earlier this year. Topicus is a subsidiary of Constellation Software, a Canadian company, which Mawer has been a shareholder in since its IPO in 2006. We view that management team as world-class, one of the best, if not the best, capital allocators globally. And they have a very good system for deploying capital, generating very good returns on capital. Topicus shares that culture and DNA, which now that they're on the board of Asseco Poland, remains a listed company, but we expect that capital allocation to improve, returns on invested capital to improve. And so when we saw that Topicus had taken minority shareholding, we could quickly ramp up or enter the position as well, given we already like the business and now we have higher appreciation for the capital allocation going forward.
And the meat counter, Dino Polska, a longer standing holding within the emerging markets portfolio.
Yeah, Dino is a chain of grocery stores. They have great meat counters, which are very valued by Polish consumers. Frequently going to the store for fresh meats. Canada, we're probably most familiar with the sausages, but all of their meats are important in their culture. And Dino's just done a great job of rolling out stores in these smaller towns where Wen and I were driving around, where there is less competition. Historically, it's been small mom and pop operators and just coming in with a better offering. They have their own meat processing plants so they can, consistently have fresh, high quality meat in their stores. They have a standardized store layout so they can quickly and cost effectively build new stores and roll out new stores and provide a great offering at very competitive prices. And that's, a boring business, but just a fantastic execution by the management team, and still have lots of growth outlook because they still have a small market share in the overall Poland today.
Peter, zooming back out, curious for your most non-consensus view with respect to emerging markets at the moment. In other words, is there something that you and the team just feel that investors writ large are really underappreciating at the moment?
I think that emerging markets as a whole, it's easy because it gets lumped into a bucket, because China's the biggest part of the universe. Most people, when they look at emerging markets, they look at the index and by extension, they're largely focused on China. And our view is that that's just scratching the surface. If you look past that, past some of the big names, you can really find these exciting companies. We talked about Dino, we talked about Asseco, but throughout the portfolio. And we're designed to do that. The way we've set up our philosophy, our process, our culture, our team, our portfolio construction really allows us to get off the beaten path, go to these other areas, have a lot of exposure and investments in places like Poland and UAE, like we discussed. And when people think about emerging markets, that's not usually what comes to mind. I think usually they're either thinking of China, which dominates the MSCI Emerging Markets Index, or sometimes I hear people even talking about Sri Lanka and Argentina, and these are actually considered frontier markets and not really part of our investment strategy. They have very minimal public equities available for investment in those countries. So not really applicable to what we're doing at all. Whereas a country like UAE is one of the wealthiest countries in the world. Poland is now closing in to surpass Japan on a GDP per capita basis. They've had phenomenal growth over the last 2 decades. And so they emerging markets, like I said, it's very heterogeneous, wide range of countries in there, great companies below the surface, not just a bunch of low income countries, but the common denominator is that they tend to be more overlooked. There's less liquidity, more inefficiency, less investor eyes on these markets. And that's where we thrive. That's where we find the opportunity.
Well, indeed. I know you and the team have spent an awful lot of time on the road. Just going back to the earlier part of our conversation on what do you maybe do a little bit differently at the margin, certainly the idea generation, the passion for getting out there and finding new businesses, common to you and the team. So thanks, Peter. Appreciate you coming on the podcast, and get back to work.
Thanks, Rob. It's always a pleasure.